will introduce our third speaker for today. Our third speaker is Mr. Samir Ahmed. Mr. Samir is the Vice President of March Specialty Construction Practice. He started his insurance career in 2012 at an international insurance company in London, where he gained experience across underwriting and catastrophe risk modeling before moving to Lloyd's London. During his 5 years working in Lloyd's, Samir was an integral part of the International Property Underwriters Division. In 2017, he moved to the Middle East to join Marsh Construction Practice in Dubai, where he is responsible for the delivery and servicing of numerous large projects across the EMEA region in varying industries, but with a focus on renewable energy. Welcome with us, Mr. Samir. Please go ahead. The floor is yours for the next 20 minutes.
Thank you very much, Dr. Shaker Faye. I will just share my screen with you. Can everyone see my presentation?
Yes, perfect. Please go ahead.
Fantastic. Thank you very much, and thanks for the introduction. So as you mentioned, I'm part of the insurance advisory firm, which is known as Marsh. So for my session today, I'll be touching on some of the sustainable energy practices from an insurance point of view. So in order just to outline the session, just to give a bit of structure, I just wanted to provide a bit of context regarding what the insurance market looks like. It's a very dynamic marketplace at the moment and is in a current state of flux. So we'll go into the details of that to help set the understanding for the rest of the session. Following which, I'll then move on to give a bit of an explanation regarding the main drivers of this state of flux, mainly to do with the loss history on the renewable energy sector and insurable losses. We'll then touch on some of the key challenges and the concerns across the EMEA region regarding loss history, regarding the availability of insurance capacity, as well as the terms, the conditions, as well as some of the options that insurers, investors, and insured parties are able to have. And then to wrap things up, we'll be tying in these challenges along with some of the ways that we can help combat these with some risk management practices, as well as insurable solutions. So to touch on the insurance industry, I'll talk to you a bit of the insurance market dynamics. So the insurance market, as with most other financial markets, goes through the traditional business market cycle of peaks and troughs. The construction and operational insurance market as a whole, with renewables being part of that, has been what we would call soft for a number of years. So what does this mean? So a soft market is an oversupply of insurance capacity, which then puts a significant downward effect and pressure on the pricing available. So this reduction in the cost of insurance has been going on for a number of years, as well as the availability of coverage on very wide terms and conditions has been prevalent for many years. So clearly, very low costs of insurance and very wide policy coverage is a perfect scenario for a policyholder, but is not such a sustainable model for insurers and reinsurers. Because of this oversupply of insurance capacity and downward pressure on pricing, insurance policy rates have really taken a dive and have reached that inadequate number. So we've got to that rock bottom pricing. The construction and operational industries have witnessed significant insurable losses globally, not just responsible in the renewable sector, but widespread. So something like an infrastructure project or a wastewater treatment, although it's not renewable specific, it still has an effect on the renewable sector in itself. So with these losses that we've seen over a number of years, spanning 10 or 15 years, these losses have had a disproportionate effect on the profitability of insurers for many years due to these inadequate prices. Insurers have reached this rock bottom pricing and have ultimately been forced to take urgent action to change their underwriting approach. So what we've seen is that globally, insurers and reinsurers have reevaluated their portfolios and their underwriting appetite and guidelines, which has resulted in a number of, quite extreme and aggressive changes to the market, which is starting to change this market transition over the last 2 years. Renewables insurance capacity has, by effect, reduced globally. So where there would be significant choice for a policyholder, someone looking to receive some insurance cover for a construction or an operations for their renewables project, now is not the case. What we've seen is that some of this capacity has left the market in various different ways. So in some instances, this capacity has left through a revision of underwriting guidelines where, in some instances 2 years ago, insurers would be comfortable in deploying significant capacity on any given project, whereas now to mitigate their risk and the potential for a loss, they reduce the maximum dollar line size that they would apply to try and manage that in the event of a loss. We've also seen in the insurance market that there have been some mergers and acquisitions of companies. So previously, where there may be some very competitive tenders where you can approach 5, 6, or even 7 insurers for quotations for large-scale renewables projects. Now it may not be the case. Maybe that 7 is now 5 or 4, sometimes even less. And in the extreme situations, what we found is with some of this unprofitability, some insurers have just exited the market completely. So they've reviewed internally that deploying their capacity and ultimately their capital is not the most viable business model for them. So they have removed themselves from the insurance market and have taken their capital elsewhere. So what do you do when you get to the bottom of the market and you realize that it's not profitable, it's unsustainable? Well, you need to have some sort of correction. So what is that correction? That correction is an increase in pricing. That's an increase in the deductibles. So that would be as a policyholder, that would be your risk, your self-insured retention, as well as seeing that a number of the policy wordings that were available have now been stripped back in terms of cover. So you're paying more for less cover now than you would have 2 years ago. And it goes to an extreme in some instances. The cover that was widely available 18 months to 2 years ago is simply not available anymore. So the market is still continuing this transition period, and the ultimate goal is to get the renewables industry and insurance sector to be sustainable and avoid this volatility of pricing and reductions of capacity and insurers exiting the market, in order to give some sort of comfort to investors as well as insured policyholders. So I've outlined some of the mechanisms of the soft market and the hard market cycles, and we know that this unprofitability has been caused by overcapacity, but I also mentioned losses. So what are these losses? And this has already been touched on to some extent today. So the main driver of the insurable losses is ultimately weather-related. So climate change, natural catastrophes and disasters. This roughly accounts for about 50% of all insurable losses affecting renewables globally. Environmental factors are a leading risk in terms of both frequency and severity, as illustrated by the green dots on the right-hand side of this graph. The risk profile for renewable energy continues to follow this trend of risk and severity, continues to go down this route. Renewables projects, and when I'm using the term renewables projects, that is anything renewables, but most importantly, solar and wind, which is what we've seen the most in terms of new developments. These projects have historically been built in remote areas in the Middle East and Africa. What we're starting to see globally is that because there is such a rapid drive for the expansion of the renewable sector, we're starting to see that developments are actually popping up elsewhere. So rather than being in remote places away from urban areas and coasts, we're now seeing the opposite, but not necessarily in the Middle East. However, given the global global marketplace of insurance, what happens in another market also has an impact on what happens in the region. So what we're seeing is that projects in the likes of the US, in Europe, as well as in Australasia, seeing solar and wind projects that are moving closer and closer towards the coast. And with that, you inherently increase your natural catastrophe risk profile, because you're more susceptible to the likes of cyclones to storm surge, coastal erosion, and wind-driven rainfall, which again in itself can potentially have repercussions. So what we're seeing here is that the risk profile is increasing primarily due to climate change. And although most of these factors are not actually happening in the Middle East, it's still having an effect on Middle East policyholders. So we do expect, and we have witnessed, that Middle East policyholders will encounter rate increases on some of their renewables programs, as well as increased deductibles. As you can see by the graph, the second to environmental factors is technologies. So again, due to the rapid evolution of the renewables industry, we've seen this has given rise to various new technologies being developed on a relatively frequent basis. Some of these technologies have limited performance data, which gives rise to significant physical damage and consequential losses. So what do I mean? So if it's untested, there hasn't been enough data to support that it can run for a certain amount of hours without any incidents. So with some of this untested data, what we've seen is that primarily to do with technology, we're seeing defective equipment being installed on site, or at least some sort of incident relating to defective or insufficient equipment on site during the end of a construction policy. So during the testing and the commissioning phase, when feedstock is being put through these technologies and through the transverters and through the inverters. What we're seeing is that if the equipment is not sufficient, then it can quite frequently give rise to a fire or even an explosion of the transformers and some of the inverters. And with that, there are significant delay in startup and business interruption losses that follow that. So that's your loss of revenue, that's your debt servicing that you owe to your lenders, and your fixed costs and your overheads, again, that need to be paid towards your lenders. Large scale and long-term renewables projects also mean that they're exposed to further physical risks and challenges when compared to short-tail or annual policies. So an annual policy will be exposed to just a 12-month cycle. So that's what we would call a one seasonal cycle. It will have your 4 seasons and relatively predictable weathers through that. When we're talking about, sort of those large scale renewables projects of, 2 to 3 years as a construction duration, what we're finding is that although that in itself is still relatively easy to predict, construction policies more often than not are delayed, and that can be due to an insurable loss that happens through the policy period, and there needs to be some rebuild time or repair time. It could just be general slippages in the delay and in the works. Alternatively, it could mean the likes of COVID-19, where we've seen across the world that there's just been pandemic government directives that have shut sites. So they've been locked out of the site for a number of months and they can't actually complete. So what we're seeing is that these 2 to 3 year long policies are actually becoming 4, 5 years and even longer. And with that, it then becomes a lot more difficult to be able to predict the effects of climate change. And with that, provides a lot of uncertainty with insurers on how to build in that additional premium and build that into your pricing by looking that far ahead. Another complication of this is that as part of an insurance advisor's role, and as well, this is a very hot topic for lenders, is that there is a process of setting appropriate insurance requirements in the various project agreements. So with the lenders, there's a finance document, changing risk landscape, it is more challenging to set requirements, standards of operational cover may be widely available in today's market. There are no guarantees that the same level of cover will be available in 5 years or 10 years or even 15 years. So it's managing that contractual landscape for a very long time. And with climate change, it's very difficult to do both those things at the same time. So what are the main insurance market concerns and challenges? Availability of capacity. Availability of insurance capacity from insurers, as I've mentioned, has reduced, and having that at a reasonable cost is weighted on the insured's risk management practices and how these practices can be demonstrated to insurers. There is a lot of scrutiny on the quality and detail of underwriting information, and some insureds actually struggle to be able to keep up with these demands from insurers in order to satisfy their concerns. As renewable industry matures and more industry loss data is available, insurers' understanding of what defines a good project versus a poorly managed project is becoming ever more important. There are some items in terms of risk management that is very important and is on the forefront of insurers' minds. So as an example, the use of tier one technologies and suppliers and OEM materials. So by tier one, what I mean is market leading technology and equipment by reputable manufacturers in order to be widely used and tried and tested. Insurers are less willing to deploy capacity on a project that uses low-grade, prototypical, or even unproven technologies. A few other risk factors is energizing priority utilities and infrastructure such as firefighting systems. So again, insurers would expect that a prudent insured would energize their firefighting systems at the earliest possible stage, whilst also ensuring that international fire standards such as NFPA and British Standard will be complied with. And of course, we've already mentioned natural catastrophe exposure, but if you are building a renewables project in a flood zone, as an example, what are you doing about it to ensure that you are minimizing your risk to the extent possible? Your critical items, your transformers, your inverters, your panels, your nacelles, your hubs, where are they? They should be stored in an elevated unit that is secured properly and away from the water flows. And the same for the site itself. Adequate drainage measures should be implemented in order to avoid adverse losses. As the Middle East has been historically infrequent from these significant natural catastrophe exposures historically, but now that has actually changed and the risk profile is very different to what it was 5 to 10 years ago. What we're seeing is that heavy rains and cyclones and flash flooding from wadi exposure is all too common at the moment. So what we're seeing is that these were considered non-modelled catastrophe exposures, and now insurers have realised that they actually need to start charging for this because it's an exposure that has essentially become free for policyholders. So there's a real magnifying glass on this at the moment. And in order to be able to make a financially backed project valid, what we need to do is to make sure that financial close reaches a point where any pre-agreed insurance requirements in the various project agreements are set at a level that lenders are happy with, but also are reasonable and achievable. Ultimately, the project needs to be bankable, but at the same time satisfying lender requirements. At times, because of this changing and transition of the market environment, what we've seen is that at times there is actually a disconnect between what the lenders are pushing developers to procure in terms of insurance and what is actually available from the insurance market at commercially reasonable terms. So we're looking to bridge that gap to the extent possible, but ultimately insurers will need to reach a position where they are comfortable with the risks and exposures, and with that, we will be able to bridge that gap. In the event that that insurer concerns cannot be satisfied, there may be other risk mechanisms that can be used in order to satisfy lender requirements. So in the event that wide defective parts cover is not available from insurers, well, we may need to look at what other contractual mechanisms and agreements are in place, behind the scenes. For equipment, there should be some sort of manufacturer warranty or guarantee in place in the event that insurance is not able to respond. So it's not just insurance that can assist policyholders against this in the renewable sector. Now, I'll just wrap up regarding how do we actually address these challenges. So as you've seen, there are a number of challenges in the insurance sector regarding renewables. We need to find that equilibrium to get to a point where it is that much more sustainable. And the market has reacted and it is looking to do this. So the availability of data for renewables continues to increase and improve, such as loss data, NatCat and weather-related mapping, technology performance. With this increased data, we can learn from loss history regarding the technologies and whether they perform well versus those that don't. Historically, non-modelled weather events are now being evaluated, whereas previously they weren't. So again, there's a bit more confidence in what insurers are looking to charge. We now understand the market challenges, and with that, we can use our experience to apply this, and insureds and lenders can appoint experienced advisors to navigate these pitfalls and the requirements of insurers. These industry experts can help with business continuity planning, engineering services provided by industry experts, can provide detailed analysis on what the risk profile is of a policyholder and what levels of insurance that they need to procure. As I've already touched on, contractual risk transfer mechanisms can be available in the event that insurance cover is not, the likes of manufacturer warranties, and making sure that there is fair allocation of risks within construction contracts between the two parties. And of course, as the renewables sector does become that much more mature, there are bespoke policy wordings regarding renewables that are tailored to what are needed. So capacity has reduced, but there are specific wordings still available and insurers willing to support for such projects. So there are many challenges, but using these proactive measures, many of them can be overcome, and allowing enough time to be able to work with insurers, work with lenders, and get into an equitable position. Thank you very much for your time.
Thank you very much, Mr. Samir, for your presentation. If you could just kindly stay with us until the end of the